You're about to join Jerry Parker, Marit Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Marit Siebert and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor Series, which is our weekly ongoing raw exploration of the world of rules-based investing, and of course where we also take some of your questions. But today we're going to deviate a bit from our usual format. One, because Jerry is out today, and two, because we are delighted to be joined by a very special guest, namely Corey Hoffstein, who really is someone that we have been looking forward to bringing on the show for some time. So let me start by saying good morning to you and welcome to the show, Corey.
Niels, Moritz, ghost of Jerry, thanks for having me. Really excited to be here.
Hey, Corey.
You know, one thing I noticed was, I mean, if you were here in Switzerland with me, you would fit right in with your surname. Are there some European, history there or?
Well, I think like a lot of American families, I don't actually know the whole truth as to the name, at least family lore. And as far as we can tell, we have no German in our name, despite in our background, despite the surname. We're pretty much Russian on my father's side. And the family lore goes that in Russia at the time, the second son was always conscripted into the army. The family didn't want that to happen, and so gave the second son to a German family down the street. And hence we are Russian by background, but German by last name. Whether there's any truth to that, absolutely no idea.
Wow, that's a story.
It's a good story it's a good story to start out with. No. As you may know, Corey, what we normally do on our weekly podcast here is that we normally just run through the markets with kind of the lens of a trend follower. And so once we do that, we'll dive straight into all of our many, many questions that we have for you. But at least for the next few minutes, you will be able to enjoy a little bit more of your morning coffee. Now, I want to start slightly different where I normally do when I do this run through of the markets. And people might think, well, has he jumped to the other side? Because this sounds a little bit fundamental. But there's certain things that I picked up this week that I thought was interesting. And in particular from another podcast on Macro Voices with Danielle DiMartino that I thought was really interesting. She's a Fed watcher, and as we know, the Fed chooses their words very carefully, to say the least. So whenever they change their terminology, I think investors should pay attention, especially those who are not yet rules-based like we are. But in any event, I want just to bring this to your attention, and that is that what apparently happened just in the last few days in Chicago at a Fed conference was that they changed the words, quantitative easing, as it was referred to, also large-scale asset purchases, which is, a pretty meaningless term, has changed, according to Jay Powell. In his speech, he kept using a new word called effective lower bound, which apparently replaces the zero lower bound. And for those who are, Fed watchers, they certainly feel that this might indicate that we can now go through the zero and essentially go negative. The other thing that happened was, now we have a new term for quantitative easing, apparently. Now it's called level policy, meaning the level of the balance sheet, whether it's going up or down, which is, to me, another pretty meaningless term. And then the forward guidance term that they've been using, unconventional policy, is now being replaced with the term slope policy, which apparently has to do with the how quickly the balance sheet is either growing or shrinking. So I thought these things were quite interesting just to note, pay attention to, because of course, even though we follow rules, we still pay attention to what happens at these institutions. But what was also quite interesting about what came out of that conference was that there was a paper being presented at the conference, which suggested that had the Fed reduced interest rates back at the last financial crisis to negative 5%, then most of all the damage to the economy could have been avoided. And I thought that's pretty interesting when they bring that out in the context of just changing these terms, especially the one where we no longer have zero lower bound, but now we just have effective lower bound. But anyways, turning back to the markets this week, we had a recovery in grains that seems to continue. Energy markets found a bit of support from the heightened tension around Iran in particular, and oil tankers being sabotaged or blown up, which also gave a lift to the greenback, actually. So with this long introduction, Moritz, you're probably completely confused by now, but how was your week from a trend-following lens?
Yeah, I am confused. Never heard you speak like that.
No, exactly. What the hell went on?
Makes me feel good about my long bond position in the portfolio.
Good.
No, but jokes aside, it's been a good week. Up about 1.5%, which is great. So for the first time now in positive territory for the year with the trend following system. Equities were kind of like mixed, some pluses, some minuses there, but the longs and bonds, that has worked well. As you know, I'm short oil now, the Brent and WTI, both on the short side, which was great in the past week. Long gold, that has worked. Long the emissions, great position, still like that one. And pretty much the only setback I had was on the currencies, with the dollar losing some steam here against some of the other positions. But I like the positioning. Definitely moving a bit more toward the long side overall again, and up more than 1%. So not complaining.
Not complaining, not at all. Yeah, I mean, on our side, another pretty solid week, I have to say. A pretty solid start to the month, and the year so far is looking very strong, actually. For us, a little bit the same, although our biggest contributor was really currencies. And I think with the sort of, weakness in some of the non-dollar currencies toward the end of this week, that certainly helped out. Fixed income still helping out from the long side. Other than that, it was pretty quiet in terms of P&L attributions. Still losing a bit of money in short positions in the grains. Made a bit of money in silver, made a bit of money in coffee, but energy pretty flat. So, but theme-wise, nothing's changed, pretty much the same. But it is interesting to see that we get more and more of these weeks where we have very decent percentage moves in many of the markets. So this price range compression that a lot of this quote-unquote QE, which is not QE anymore, has perhaps had an impact on markets and trends. That seems to be disappearing, at least for a while. But enough about the markets. Now we need to go to something that is much more important, and that is you, Corey, of course. It is, as I said, great to have you here today and to share sort of your view on some of the things that we debate. But before we kind of get into the detailed conversation, I thought instead of talking about sort of your official CV to frame the conversation, maybe I thought about you could think of something that is not necessarily on your official CV, but something that has had a big impact on you and perhaps influenced some of the choices that has led to where you are today, the way you think about investing today. And of course, if you want to use a few things from your CV, feel free to do so. But I'd love to frame the conversation to give our audience a little bit of a background on where you're coming from.
So I can really probably give one really quick anecdote and then a little bit of a longer anecdote that I think a little bit of both maybe nature and nurture that's led me to where I am today. So on the nature side, I think what always helps inform the conversation is the nickname my parents actually gave me when I was younger. And I think a lot of parents give their kids nicknames. That's a little bit of an identity to their personality. And as embarrassing as it is to admit, the nickname my parents gave me was Safety Boy. I guess as a young kid, I was never the one who would run around the pool. I always had my, little swimmies on to make sure I was safe. I never wandered off. I was just always through and through on the safe side. And that's, I think, always been part of my DNA. Everything I tend to focus on tends to be more about the management of risk and trying to identify previously unidentified sources of risk, identify uncompensated sources of risk. And that really permeates my thinking on the investment side. So that's sort of one side of the equation. On the nature side, I think just very naturally, I come to investing with a very risk-based mentality. On the other side, a bit of the nurture, very early on in my career, I was actually spending some time with my father's financial advisor. And as sort of a summer gig during college. And one of my jobs was to sit in on interviews of portfolio managers who would come through. And I remember on one very particular day in summer 2007, there was a small cap value manager, mutual fund manager, who was in the office. And prior to the meeting starting, I just was looking to kill time, and I asked him what he thought of the market. And he gave me an incredibly bearish prognostication of what was going to happen. And I remember that so distinctly because it was summer 2007, which in hindsight, he was absolutely correct. But he was one of the earliest people I had heard really provide a bearish outlook and a bearish thesis. And it really caught me off guard. And so I asked him what he was going to do about it with that view in mind that was so contrary to what I had been hearing. And he ultimately said, well, look, my job as a portfolio manager is to provide the best small cap value experience I can. By prospectus, I have to be 95% invested. And ultimately, at the end of the day, I don't even know the individuals who are investing in my fund or what their suitability is. So with that in mind, I'm really not going to change anything. I really think it's up to the financial advisor who knows the individual to ultimately determine whether this risk is appropriate for them and to take them out of my portfolio if it's not. I said, okay, that sort of makes sense. And so after the meeting, I stepped aside and I asked my father's financial advisor, sort of relayed the conversation and asked him the same question. And he said, well, I think that's crazy. The whole reason I'm hiring an expert in the small cap value space is to manage risk. If I'm not an expert in small cap value, how should I know when it's appropriate to have risk or not take risk in that space? And I thought that was an equally good argument. And so what I ultimately saw was two people pointing the finger at each other as to who was ultimately going to manage risk in the traditional sense. And to me, that just meant preserving capital within the portfolio. And that really, for me, set off a chain of events that ultimately led to a sort of portfolio management style that had the flexibility to go to cash and really focused on preserving capital first and foremost.
I mean, it's interesting you say that. I mean, you mentioned sort of your entrance around 2007, and then of course this conversation. But something I've come across, which I actually think could also be true, and that is just that we as professionals, we very often, I think, get influenced significantly by the time we enter the industry. And it reminds me of a conversation. I know you're, obviously you've been living in Boston for a long time. I was in Boston last year in spring and had a meeting with quite a big family office asset management firm. And the guy I met with, was very honest and said, listen, I know I'm biased against trend following because I entered this industry in around 2009. And since 2009, I haven't really seen any, massive positive performance being generated by at least the industry. So he knew of his bias, but he attributed all to the fact that he entered the industry in 2009.
I think that's 100% on point. In fact, it was the original idea behind my own podcast. So I come into the field with a very quantitative background. I implement 100% systematically. And yet I knew that behind the curtain, when I talk to my other friends in the industry and peers who take a similar approach to investing, that quantitative systematic view, as much as we claim it is evidence-based, is very much colored by our experience. And there are underlying human assumptions that go into it. And so the whole idea behind my podcast originally was to say, everyone who's coming on is a systematic investor, but I want to talk about their background and do a whole sort of part of the show that talks about where they came from and try to dig out how that actually ended up influencing how they think about investing. And I think it's very common that when someone enters the industry has a very large impact as to how they think about investing.
Yeah, interesting. Moritz, what are you?
Yeah, hi. I know it depends on the vintage year, so to say, right? We're all like,
What year did you enter, Moritz? I'm just curious now.
say again.
Now I'm curious. What year did you enter this this business?
Well, around the tech bubble, so just shy of the year 2000. I think 1997, 98 is when I first got interested in trading and put the first positions on. So I was able to live through that period of time, obviously without any experience. So you already know what the results were, right? Without me telling you what they were.
Yeah.
But yeah, I mean, so speaking about that, Corey, I mean, how did you get interested in financial markets? I mean, with the studies that you've done, I mean, you've mentioned your quantitative background, but why go into finance and not into some other area?
So I very much originally did not intend to go into finance. I actually, from a very young age, and I don't recall why, but I actually taught myself how to program very, very early on, sometime around when I was 12 or 13. And obviously being a bit younger, grew up in the video game generation, very much had my youth colored by the Super Nintendo and things like that. And so as a young man, thought I would end up programming video games for a living. And so actually in high school, I spent quite a bit of time in my spare time actually programming video games for the Game Boy Advance and things like that. So very, very nerdy background. And ultimately ended up attending college to pursue a computer science degree. And as soon as I got to college and sat in some of my first classes, despite absolutely adoring programming and computer science, I realized I was not a particular fan of the people I was in class with. And I realized it wasn't going to be a career I could pursue that would ultimately make me happy. The idea of sitting behind a computer 24/7 and interfacing with some of the people that I was in class with. And so I got a little lost for a while, didn't quite know what I was going to do. I continued my computer science studies because that was sort of what I had decided to go to school for. But somehow, and I honestly can't recall, but somehow just got introduced to finance. And I realized in meeting with my father's financial advisor, who was kind enough to introduce me to a number of people in the industry, that there was this really interesting intersection that could be made of taking a lot of the computer science background I was developing and had originally, and being able to implement a lot of these investment ideas systematically. And so that was sort of the foundation. Ultimately ended up going to graduate school right out of undergrad. I went to Carnegie Mellon's Master's in Computational Finance program because I was very intrigued at that point about more complex derivatives. So this was end of spring 2009. I ended up graduating from college, went into Carnegie Mellon immediately, thought I would ultimately find myself at a bank, whether it was Goldman or JP Morgan or Deutsche Bank at the time was a large hirer out of the program, go to a sales and trading desk to trade complex derivatives. But obviously mistiming, and timing is a little bit of everything in life, mistiming how much of those jobs would disappear from Wall Street. But all of that ultimately culminated in my background of really a strong passion and focus on the purely quantitative systematic implementation that I pursue today.
Interesting. So instead of going to work for one of the big banks or brokerage houses, you immediately started off with your own business, right? Together with your partners.
Yeah, I completely tripped and fell into that, to be quite honest. I would love to say we're about to hit our 11th birthday, got started in August 2008, and I would love to say that we had some tremendous foresight. But really what had happened is after that initial conversation I mentioned where I had interviewed the small cap value manager, I started going down a deep rabbit hole of research, trying to think about ways in which I could run models in my own portfolio to manage risk. And I think sometimes when you are new to an industry, you can be untainted by sort of the common thought of the industry. You're allowed to approach things in a fresh way. And so for me, still being new to the industry, I didn't realize that the idea of having a portfolio that could go to cash was so against the grain. For me, when I got started, ETFs were a very obvious vehicle to be implementing with. I didn't know that the rest of the industry hadn't really adopted them. And so I started developing these models, ETF based, mostly trend following driven, though at the time, trend following was still, at least in the circles I ran in, somewhat of a dirty word. People didn't like the word momentum either. So I used other words to try to describe what I was doing. But ultimately, it was sort of a sector rotation based trend following program that could go to cash. It caught the eye of an asset manager I knew who asked to license the output of the models from me. So basically the trend signals I was generating, and then he would manage portfolios based on those trend signals. At the time, I was a broke college student. So to me, I was like, absolutely, I could use some beer money. Put the company together as just a pure intellectual property holding company, would generate the signals and license them to him each week. And that's really how it got its start. By the time I graduated grad school, that asset manager had gathered some significant assets tracking the strategy. And I said, you want to know what? This is a real opportunity for me to pursue a more entrepreneurial drive. I can always come back to sort of the classic Wall Street approach, but this is now a business that's generating positive cash flow. It seems like post 2008, these ideas are more attractive to the industry. ETF managed portfolios are growing in popularity. Let's see if we can turn this into a business.
Pretty interesting. Although I do think that trend following might still be a little bit of a dirty word, despite the years past.
Well, everyone started to love it, and then I think lately it's gotten a little dirtier.
That's true. That's true. Well, we'll keep fighting for it anyways. Now, one of the things that we spend a lot of time discussing on the podcast, and where Jerry and I actually often get into a little bit of a debate, is the question about diversification. And I know you've done some work on this, and was wondering if you could kind of break down kind of the three components of diversification in the way you see it, kind of the what, the how, and the when, and maybe we can spend some time getting a little bit deeper on that, if you will.
Absolutely. And I actually listened to the podcast you published earlier this week. You and Jerry, I believe, were actually arguing about this very topic. And I want you to know you're both wrong. We'll just start there. No. It's a really interesting topic to me. I put this in one of the categories of very unsexy topics that has a huge impact on portfolios. Everyone loves to talk about their secret, proprietary, complex blend of signals and how they're generating alpha. But I think so much more of a portfolio's objective is achieved in the really boring stuff. So just to take a quick little tangent, and then I'll get back to your question. I tend to look at a portfolio as being very akin to baking a cake or cooking a meal. There's the ingredients, which for quants and systematic investors are the signals that you generate from your trading strategies, so the buy and sell signals. But then there's the recipe that takes those signals and actually turns them into a portfolio. So I would bet that if you gave, we all assume, say, a multi-asset futures portfolio, and we were all given the exact same signals. So Niels, Moritz, and let's say Jerry was here and I'm on the show, and we're all given the same set of buy and sell signals, we would not necessarily construct the same portfolio. And yet so much emphasis in the industry is on what are your secret signals, when in reality, how you choose to implement those signals, when you rebalance, how you manage diversification within the portfolio are huge contributors to a portfolio's success, in my opinion. And it goes totally unfocused. So to your question about diversification, I look at diversification along what I call the three axes of diversification. And the first one is one that people are very, very aware of. And this is what I call the what axis. What are you investing in? And this is sort of your traditional correlation-based diversification across different asset classes. And I think the benefits of this kind of diversification are very obvious to people. You are looking to exploit the sort of differences in relative performance, try to get that quote unquote free lunch of asset class diversification by maintaining a high level of expected return, but taking advantage of covariance opportunities to reduce volatility. There's also the benefits of reducing idiosyncratic exposure to different asset classes and large negative skew moves. So those are sort of well known. The other two axes almost get no focus, but I think they are incredibly important. So the second axis is your how. How are you making these investment decisions? And I call this process diversification. So this comes in going back to sort of the podcast and the debate you guys were having about trend following signals. Should you optimize your trend following signals? Should you stick with one set of trend following signals? I would actually argue that both sort of miss the point of why are you only using one set of trend following signals in the first place? And we can go really into depth here, but if just as a simple example, I think 12-month time series momentum and a 10-month moving average both work, why wouldn't I use both signals in the portfolio? Because there's going to be times that one signal might work, one might not, and you get the benefits of process diversification. And here you don't see sort of the same decrease in volatility that you see with asset class diversification. But what you really do see is a reduction in negative idiosyncratic events that can occur because of your specification risk that you're taking when you only choose one process. And you can think of this very broadly too. A lot of people make this debate between should I be 100% trend following? Should I be 100% passive strategic? Well, they're different processes that have different underlying assumptions to them. And the reality is they tend to do well in different market environments. Trend following can do very well in environments like 2008, 2013, when there are very clear trends in equity markets, for example. Your strategic portfolio tends to not do very well there. There's a carrying cost of having things like lower risk assets in the portfolio that reduce your opportunity to participate in years like 2013. On the other hand, whipsaw years that are tough for trend following tend to be very good years for strategic. So my question would be, unless I'm incredibly overconfident that one will outperform the other over my investment horizon, why wouldn't I diversify my process? And then the last axis, and I apologize for meandering so long here, I'll shut up in a moment. But the last axis that I talk about is the when. When are you making these decisions? And this is sort of a diversification of opportunity. And I think this one very much goes overlooked. I actually just had a paper published in the Journal of Index Investing in the most recent publication about this topic. And it's a little less clear on sort of the continuous trend following side, but I'll give a very, very basic example, which is, and this comes back to a lot of the indices that we see created nowadays. They are rebalanced on a very fixed schedule. So let's just use a very simple example of a value portfolio that's rebalanced once a year. Well, if you rebalance that value portfolio every March, you might end up with a very, very different portfolio than someone who takes the exact same process, exact same methodology, but rebalances in September. You're going to be very subject to the opportunity set that's in front of you at the point of rebalancing. And so a lot of people don't focus on this, but trying to diversify when you rebalance, when you evaluate your signals, and how you incorporate that into the portfolio can, again, have a dramatic reduction in the sort of timing luck that your portfolio can be subject to. So big picture, I look at diversification across three really important axes: what, how, and when. And I think the how and when go dramatically overlooked in this industry.
Yeah, no, I mean, I don't want to speak for Jerry when he's not here, but I mean, I completely agree with you. I mean, one of the things we found at our firm is definitely the importance of diversifying the process, and we've been doing that for more so than from 1974, when obviously computers weren't that sophisticated and powerful. Our founder obviously was limited in some ways to how many time frames we were using, et cetera, et cetera. But since sort of 2006, we've increased that massively. We've introduced other ways of doing trend following and introduced further diversification within that. And I agree. I mean, I think it's helped. I think it's made it more robust. I think the debate, Jerry and I, at least one of them recently we had, was more about, should you put all your money in trend following because it is so diversified and different asset classes and all of that, or, and I was arguing the case, I think, that if you're a young person, maybe another route to go was to kind of go the Ray Dalio route and say, if I can find, 10, 15 different return streams that are lowly correlated, maybe I can just construct a portfolio like that, and I don't have to worry so much about it and have to look at my statements every month, because the structure or the holy grail that he found is really the benefit of that kind of diversification. So yeah, we've had our good debates on that, but that's super interesting in terms of what you found as well, Corey, for sure.
And those processes, they're all, at least as far as I'm concerned, they're part of the investment process anyways. They're built into the system, right? There's different asset classes, there's different types of signals that are being generated automatically, and then as to the when, well, it happens when it happens, right? It's driven by the price. So all of these three axes are included. But the point I wanted to make, and I think that very often goes overlooked by a lot of the people that are interested in research, such as yourselves. You read an academic paper and the authors will say, we're testing a naive trend following strategy, say, 12-month momentum, and they will only implement that and observe it at the end of the month. So they're guilty of exactly ignoring the last two axes that you've mentioned. They're using different asset classes. Okay, that's fine, but they're only using one type of signal, and they're using it repetitively at one singular point in time. And then I also, sometimes question, well, what are the results really worth? They're being presented in that paper, because they may just be, they're really lacking the sample, a statistical sample for that strategy. It may just be one lucky outcome that they're looking at, and then they're building a whole research paper around it. And, I think that's questionable.
I would argue it goes beyond just research. So I can give one specific example and then a number of anecdotes. But one specific example here, and this is outside the realm of trend following a little, but and it might be an example a lot of people are aware of, is research affiliates fundamental indexing. And so it's very interesting, as that was an approach for people who aren't aware. Research affiliates, large quantitative equity manager, their fundamental indexing approach. They might object to the way I describe it, but it's very much a value tilt type portfolio. And when they initially brought it to market, it had an annual rebalance. And so just rebalance once a year, and the weights remain consistent. And what was very interesting is they, in real time, lived through the 2008 and 2009 environment and found that their portfolio outcome was heavily skewed by their choice of when to rebalance, which I believe was in March. And they did this analysis that found that if they had rebalance, say, in September instead, or any other sort of quarter end, their return dispersion in 2009 relative to the market, I believe that the March portfolio underperformed the market by a couple hundred basis points, whereas if they had rebalance, say, in September, they would have outperformed the market by 1,000 basis points. So exact identical process, and I think it was like almost 1,300 basis points of return dispersion just based on when you rebalance. And so this is something that very much exists in the industry. You see it in a lot of ETF products, a lot of index-based products that just have an annual or semi-annual reconstitution. But I also see it even on maybe more the tactical ETF side. So a lot of folks now that I work with, financial advisors, implement some sort of tactical ETF rotation program. And they very frequently are using momentum and trend signals because they're somewhat easy to measure, but they are almost always implementing them at the end of the month. And I have seen asset management firms that do the same thing that have gone out of business because of that choice, because there's such a huge amount of timing luck as to when you elected to sample your signals. And so again, it's not as obvious how it comes into play when you're looking continuously every single day, But I've found in practice, a lot of firms aren't doing that. They are just rebuilding their portfolios maybe once a month. And that can be very dangerous. And there's very easy fixes that I'm happy to go into and discuss. But it is prevalent in the industry in index creation and a lot of these new smart beta products that are out there.
Absolutely. Moritz, do you have a question as well you wanted to dive into? Otherwise, happy to.
No, I think that's fine. Great. Thanks for answering that. I agree with all of that.
Yeah, sure. I mean, one of the things that, we also talk a lot about, and I think also that people ask us, not just on the podcast, but also in our day-to-day job, and that is, how do you know when your model or your process isn't working anymore? And it's kind of this continued battle or constant battle between sort of the theory and the data and so on and so forth. Why don't you talk a little bit about this topic in terms of what you've looked into and found, and I guess this goes across different factors. I mean, obviously we know that not all factors work all the time. Trend following certainly fits into that, but even though I'm not very well versed in value, I from tweeting or from tweets and reading about it, it seems like value has been going through a rough time as well. So how do investors and how do we as managers sort of balance those two things in terms of when is it not working? When has something really changed? And this time it really is different. And when are we just going through one of these periods where things are not working as they would normally do?
I love this topic because I think it is a not very easy topic to address. Very complicated. I actually wrote a piece about this. I think it was last June. I called it Factor Fimbulvinter. And the idea behind the name of the piece is, for people who've never heard the term Fimbulvinter, it is in Norse mythology, the never-ending winter that occurs before Ragnarok, which is the end of the world. And the reason I chose that name was because I think when a lot of people think about a factor or systematic strategy no longer working, they assume all of a sudden it's going to perform negatively. And the reality is, if a strategy is getting arbitraged out of the market, it doesn't mean the strategy is necessarily going to perform negatively. And I should be explicit here. Gross of costs. Costs will obviously be a drag. But gross of costs, it doesn't mean the strategy will suddenly perform negatively. Because if that were to occur, well, then all of a sudden you could just invert your signal and now you have a positive performing strategy again. What you get instead is when something gets arbitraged out of the market, whether through crowding or the signal just no longer works, is you get random behavior. And so as quants, this can be very frustrating because random can be random positive, in which case we think a signal's still working, when in reality it's not. We just got lucky. It can be random negative. And often we're looking at that random negative as a sign saying, has this stopped working? So trend following, I think, has been very frustrating for a lot of folks in the last decade. Value versus growth. Value has underperformed growth pretty consistently over the last decade and has a lot of people questioning, does this factor still work? I think where we've really painted ourselves into a corner as a community, as quants, is that we have beat our chest endlessly over the last decade or two about the preponderance of data supporting these signals. And we say, look, something like value, systematic value investing, price to book, it has worked in the US for hundreds of years. It has worked abroad for hundreds of years. You can use it to time countries. You can use it to time sectors. And so that sort of breadth and depth gives us an incredible amount of statistical confidence. And we beat our chests about this and say, why would you invest any other way? We have all the evidence in our corner. The problem becomes when we no longer believe that signal works. So there's a lot of people today, and I'll use that price to book concept, saying, look, price to book doesn't make sense anymore in the current era of how companies are reporting assets on their balance sheet. There's all sorts of non-tangibles. It doesn't make sense for certain industries. Really not the right value metric. The original construction by Fama French was done in a non-sector neutral manner. That has huge impacts. It's really sort of a technology versus financials or a huge inflation sensitive play. And there's all these arguments as to why it doesn't work. The problem is, even as performance has meandered for the last decade, it's not nearly substantial enough to undo the statistical significance of that factor. And so this paper I wrote simply asked the question, let's assume today all the factors stop working. So I used value, momentum, quality, low beta. And I said, let's assume they stop working and have completely random performance going forward. If we update our statistical significance in a Bayesian manner, trying to constantly re-ask the question, is this significant? How long would it take for us to ultimately be dissuaded by the evidence? And I used all these Monte Carlo techniques to simulate it out. I did it multiple different ways to try to avoid different assumptions. And ultimately what I found was that my career will likely be long over before anyone's come to a statistical conclusion as to whether these things work or not. I think small cap is a perfect example. Small cap has pretty much gone nowhere point to point. It's been a drawdown as a factor for the last 30 years. And it's only in the last 3 or 4 years that people are finally saying, you want to know what, this might not be statistically significant anymore. So think about that. You've got something that's been statistically significant. It took 30 years to undo, and yet that small cap premium has really permeated the industry in all the years since. So I think it puts us in a really tough place as a community, because when we bang our chests about all the statistical significance, it prevents us from making changes. Because if I say today, I don't want to use price to book anymore because I don't think it works, a savvy investor is going to ask me, well, how do you differentiate between all the stuff you're saying has evidence, and now you're saying, I don't want to use this despite the fact that it's still statistically significant? So I think as a community, we're at a point where I think we need to be a little careful as to how we're communicating this, because we're going to put ourselves in a box and not be able to evolve our strategies out of the way of potential changes in the industry that may not be showing up based on statistical measures, but may, truly make sense from a more common sense point of view.
Just as a quick follow-up before you, Moritz, jump in, but I'm just curious. Given the fact that trend following is certainly, in the opinion of many, including myself, is based on human behavior deep down, does that give us any hope that trend following will continue to work, so to speak? I mean, does it put it in a slightly different category compared to other factors?
So it's a great question. I think there's sort of two ways you can make a cut at this. The first is, where do you think an edge comes from? And I'll sort of lean on the Mobison framework here. And I would say there's maybe 4 sources of edge. One would be informational, that you just have better, unique information. Obvious example there is insider information, which is illegal. But if you've got better information than people that the market doesn't have, you can hopefully exploit that. The second is analytical, which is everyone has the same information, but you're able to use it and see things in the data in a different way. And so that might be right now today sort of alternative data. So alternative data might be an arms race for an informational edge as well as an analytical edge. That the data's out there, but people are able to find unique insights into it. I don't think trend following fits in those. It's an open secret. The signals are not hard to calculate. I think trend following falls into maybe the third category, which is this behavioral edge, which is the idea that there are certain strategies that are just hard. They're hard to stick with, hard to implement. And that sort of, by definition, being difficult makes it so that a lot of weak hands end up throwing in the towel and ultimately passing the alpha opportunity to the strong hands that can continue to hold. Now, the question is, why should there necessarily be alpha with trend following? And there I would say, well, there's really two arguments that when it comes to factors. You either have a risk-based premium, in which case it's not really alpha, you're just getting compensated for risk. And so a lot of people would put value in this category, that you are buying companies that have a high chance of going out of business, and therefore for the market participants to avoid that risk, they want to sell it. And so in a sense, you're providing insurance to them by taking it off their hands and demanding a premium for it. So that might be the more risk-based premium. I think it's very hard to argue why trend following and momentum are necessarily risk-based. And so the argument that supporting those tends to be more behavioral. Investor underreaction, anchoring biases, disposition bias, herding behavior ultimately creates those three together, the emergence of a trend that can be exploited if you're going to track them and implement it systematically. And I think what's interesting is the idea that because that is just very inherent in human behavior, you would expect that to persist. I think trend following is really, really interesting. And I'd love to dive into this because it is one of the only anomalies out there that you can sort of disentangle and say, well, there's some behavior to trend following that's really attractive from a purely mechanical process. It's mechanically convex, which gives it really interesting diversification properties to a portfolio, regardless of whether it adds any alpha. And then there's the whole premium side of it, which requires the autocorrelation of returns, which is a little bit more questionable. But I think it makes, on a standalone basis, whether trend following inherently it creates a premium going forward. I still think even if that premium is dramatically reduced or outright questionable, there's mechanical aspects of trend following that I still think make it potentially worth the incorporation within a portfolio.
Yeah, I mean, I loved your answer there, and it reminds me of a podcast I heard this week, actually, with Patrick O'Shaughnessy and Ted Seides, where I think Patrick was saying something like, I mean, we don't mind sharing a lot of our ideas and information as long as it's behavioral, because it's already out there, so to speak, and it's about the difficulty of holding on to the strategy. That's kind of the real secret. But if it's something where, as you say, maybe we have a little bit of better information here, or some kind of other edge, then they were much more careful about sharing. And I think it ties perfectly into your answer. So I appreciate that. Moritz, sorry, I've been going on for a while.
Yeah, I like what I hear. I agree with that, observation on the edge coming from the behavioral side of things. Sometimes I question or ask myself, now that, everybody has apparently read Tversky and Kahneman, and we're getting all more familiar with our own biases, especially as they relate to our investment performance, will that also potentially have an impact on that edge going forward, right? More money is managed by quant funds, the properties and the advantages of being systematic. Many people understand those. I know it could be more than, there are right now, but it's kind of like, that news is in some way also yesterday's news. The information is out there. And the question is, what will it do to the performance of the factor going forward? And with all of that, looking at a historical time series and testing a system, what you've said there is correct. I mean, you can do a 100-year backtest on trend following, create a massively large sample size, and it would take you years and years and years to dissuade you from stopping to trade that factor. But we all live in the right here, right now. Clients are notoriously impatient. They will not have the patience to go through, or most of them don't have the patience to go through a 3 to 5 year drawdown with you. And they will question the approach. And so I'm not sure if there is a real scientific answer to that, in the sense that, is something crowded? Do I need to stop trading it now? In my view, it has to do more with experience and being a part of the market, observing how your system trades, having a look at liquidity, how many people are trading in potentially the same way to the extent that you can know it, right? Kind of like staying on top of things, living through the way that markets evolve, because they always evolve, and, getting a feel for when the thing may have a problem, and then adapt and, make changes. But, I'm not sure if there is a clear-cut, like 1-0 type of thing where you say, now it's the time to shut the thing off, because it's definitely, from statistical point of view, stopping to work. See what I mean?
I think there's a really interesting line of thought here that you bring up, Moritz. One of the questions should be, with this transition of more quant funds coming out, more systematic implementation, more ideas chasing the same performance, and then on the other hand, a lot more people adopting a passive mentality, how is that? Is it people ultimately walking away from the poker table and we're losing the misbehavior that we're trying to exploit? I think what's really interesting is I think we need to separate the universe. I think there are those investment strategies that happen intra-asset class. So, for example, value stocks, picking value stocks. I think there's a lot of assets that chase that concept. And regardless of how someone forms their portfolio, they probably have a slice of their portfolio that's dedicated to buying value stocks, because it's just a very well accepted common narrative, and everyone wants to buy, high quality companies at a cheap price. And so you have a lot of money, regardless of portfolio formation, sort of pursuing the same signal. I think trend following, especially multi-asset trend following, falls a little bit outside that category, because what you see, and at least it's been my experience, and I think this is very common in the industry, is people tend to very much lock down their top-down exposure. And so there isn't a lot of cross-asset exploitation that happens. The risk budget that exists in a lot of personal portfolios, advisor models, as well as institutional models, don't allow for very rapid changes in cross-asset exposures. And I think that structural limitation that exists within the industry will help strategies like trend following and global macro and sort of these cross-asset rotation strategies continue to be successful and less likely to be arbitraged away from a pure saturation perspective that it almost structurally limits how many people can try to pursue these edges, because there is so much limitation as to how that active risk budget is being pursued in a cross-asset manner.
Very interesting. Now, do you have anything, Niels? Otherwise, I'd like to ask some questions about risk, because risk is all over your presentations, Corey, and you've mentioned it in the introduction that is your core focus, right?
Yes, it is.
So one of the things I've read in the papers and the materials that you've sent us is sequence risk. And, I kind of got my head around it, but maybe to the benefit of our listeners, could you explain what you mean with sequence risk and why that is a risk, especially if investors or as investors approach their retirement?
Sequence risk is this basic idea that the order of returns matters. And if you take a Finance 101 course, the first thing you're taught is that the order of returns doesn't matter. Whether you have a 25% gain and then a 25% loss should leave you in the same place as if you have a 25% loss and then a 25% gain. And the idea of sequence risk is that math is only true if you ignore any sort of portfolio contributions or withdrawals. And so there's not a lot we can do on the contribution side. People are perpetually saving. But when someone has exhausted their human capital and are now trying to live off of their investment capital, so someone entering retirement, what you find is that the order of returns very early on in their retirement can have a dramatically outsized impact on the type of retirement lifestyle they're able to maintain. So if you retire in 2007 and your first year of retirement is 2008 and you have a 60-40 portfolio, you may be sticking to a plan where you're only taking a 4% withdrawal. But because your portfolio has seen such a large drawdown, that absolute value, when you calculated what that 4% was going to be, if you have $1 million portfolio and you were going to take 40,000, well, at the end of 2008, your portfolio is no longer $1 million. It's much less than $1 million. So that 40,000 represents a much larger proportion. And so what you find is that very early in retirement, if someone enters a sequence of either a low return environment where their withdrawals represent a very real drag on the opportunity for portfolio growth, or they hit very large drawdowns early in retirement, it can have a dramatically outsized impact into the longevity of their portfolio. And so there's all sorts of ways you can try to avoid this. And this is inherently the idea behind a portfolio glide path. This is why people de-risk their portfolios. There's actually some really interesting analysis you can do where if you look at sort of a historical efficient frontier between stocks and bonds and say, I want a portfolio at retirement that gives me about a 10% volatility, let's say, you end up, if you use sort of the full history of US stocks and bonds, with a portfolio that's got a heavy allocation to fixed income, call it 40, 50% into fixed income, which is sort of very common, that 50-50, 60-40 that people hit near retirement. But if you were to simply remove from the data the worst 2 years of stock returns or the worst 3 years of stock returns and recreate that efficient frontier, you would dramatically reduce the amount of fixed income exposure you would be carrying around, which tells us that for people trying to hit this risk profile, there's a huge amount of safety assets they carry in their portfolio only to help insure against these, once or twice in a lifetime, really negative, bad environments that are tough to predict. So a lot of the work I do in trying to manage risk is saying, well, are there more proactive ways we can try to manage risk to help people react in these sort of market environments, but not necessarily carry around a tremendous amount of fixed income? Or are there ways in which we can try to diversify our diversifier so it's not just fixed income, but incorporating strategies like trend following, which have historically done really well in these sort of crisis environments that can have such a big impact on investor lifestyles when they occur early in retirement. So that's the core idea behind sequence risk. And again, to me, the solution to managing sequence risk is very naturally this idea of glide pathing a portfolio. But I think we can go a step beyond that. And again, reincorporating these ideas of diversification, diversify our diversifiers. If we're going to have a strategic portfolio, how can we complement it with ideas like trend following that might be able to help protect us in different sorts of market drawdown environments?
Got it. Really cool. Nice. Another one on risk, which I also found in your papers, is you say risk cannot be destroyed. It can only be transformed. What do you mean by that?
I have to stop writing papers because I only get in trouble when people find this stuff. So it's one of my favorite lines to say. And this actually goes back to my graduate school days where the program I went to, this computational finance program, was all about pricing complex derivatives. And one of the patterns that I noticed in the coursework was that everything we were doing was ultimately about the identification of risk, the isolation of that risk, extraction, packaging, and pricing. And all we were really doing was taking risk in some form and passing it to someone else who was willing to bear it, and either paying a fee, or if we were going to bear the risk, demanding a fee to bear that risk. And so that mentality really permeated my view at first of really assets in general. And so when we ask ourselves, for example, why do we expect to earn a return for holding equities? Well, a lot of people point to the fundamental growth of the business, but at the end of the day, someone had to sell us their security. And the question is, why should it earn a premium beyond treasuries if we all believe the prices are going to go up? Well, it's because there is some uncertainty to that. Uncertainty both over the long run and uncertainty within our defined holding period. And for that risk, we're going to require a reward. So another phrase that I commonly say is no pain, no premium. Without this pain, we shouldn't have the expectation to earn a reward. As time went on, and I started doing more and more work on the portfolio side, I realized this idea of risk transference really almost hit every aspect of the portfolio, and that it's all about the trade-offs you're making. That when you have a risk, you are either going to bear it, and hopefully it's a compensated risk, and the idea is you should only be holding compensated risks. But there's other times when you might say, this isn't a risk I want. I'm going to take it out of the portfolio. But ultimately, the risk I'm taking on is an opportunity cost risk, that by selling this risk to someone else, I no longer want to hold it. I am taking on a different type of risk, which I might have been wrong. This permeates through to things like the process you use. So you might choose, for example, to implement with some specific model or some specific trend following formation period or holding period. All of those are choices that inherently have some sort of specification risk that go along with them. And as you change those, you're just sort of moving around where that risk is. And so I often think of risk as this idea of almost like this blob. So you can almost imagine Play-Doh in front of you and all the future states of the world. And you can take that Play-Doh and move it around to the future states of the world. And so if you hold all equities, for example, in your portfolio, you might have a big blob that exists in these super negative economic states. And what you might do is say, I don't want to be subject to risk just in those really bad states because my career perhaps is positively correlated to them. So I'm going to incorporate some fixed income. And so what you've done now is you've almost taken your hand and smushed down on that Play-Doh and smeared it across other states of the world. So the mass of risk that you have in that super negative state is lower, but now by holding on to more fixed income in your portfolio more constantly, you are reducing your opportunities for positive returns in other states of the world, which is just a different type of risk. It's an opportunity cost risk. And so that's really where this idea comes from, that risk permeates everything. It's never really destroyed. Everything we do is a game of trade-offs. And I think it's really important to always keep that in mind as to when we're making changes to a portfolio or constructing a portfolio, always trying to think about what trade-offs are we inherently making in this construction or this decision.
If I could just butt into this topic, I think it's very interesting. And I want to maybe ask you, just on a very related note, a kind of a real live conversation I'm having right now with a very large investor, and where they're basically, although the let's call it the research side or the analyst side is convinced that they should have an allocation to trend following, but the PMs who have to make the decision essentially it has to weigh up, why should we have trend following versus just buying more duration, i.e. fixed income? I mean, if you were going to talk to them directly, and I'm thinking you're going to argue that trend following would be a better choice. But given where we are right now in the environment with rates where they are and so on and so forth, knowing that what they're worried about is some kind of positive return, especially when equities go down. I mean, what would you tell them if you had the opportunity?
I think for me, it's always a question of, and these are always hard conversations because I don't think there's a black or white answer, because it's always very subjective as to what the investor's goals are, what their utility function really is. But I think what you can say is, all right, let's think about the different states of the world. In the last couple of crises that have been economic shocks, you have seen negative realized correlations between stocks and bonds. You've seen the flight to safety. You've seen the dollar pop. You've seen treasuries pop. That was not always the case. It's very easy to go back another 2 decades in the US and find periods where stocks and bonds did not have a negative correlation. They had a very strong positive correlation because market fears were inflationary. We were concerned about inflation shocks, not as much economic shocks. Now, those ultimately boiled into economic shocks. But when you have a market that the foremost risk on its mind is inflation, you end up with positive correlation between stocks and bonds. So the question becomes, what I would ask ultimately is, again, in this idea of transference of risk, are you willing to get rid of trend following and bear the risk of the market environment, which is positive correlation between stocks and bonds? Are you willing to take all this sort of Play-Doh in front of you that is nicely smeared out? So yes, you're underperforming in maybe today's environment because trend following isn't doing as well, but in future possible environments, trend following is more likely to help, in that case where stocks and bonds are positively correlated. Are you willing to lump up all of that Play-Doh and put it in that environment? And if you are, great. Just recognize you're taking that risk, that you are making a bet that stocks and bonds are going to remain negatively correlated for the foreseeable future as it relates to the lifetime of your capital. If you don't want to take that bet, then maybe you should think about how you should diversify your diversifiers. And by the way, trend following has a phenomenal history of doing well in a variety of different drawdown environments, not just economic shocks, but also inflationary shocks. And so that's the conversation I try to have. And look, again, some people will just say, yeah, I'm willing to make that bet. I think there's also, we need to recognize the agency problem here, that it is not just about the utility of the asset owner, but the PMs who have very real career risk tied to this. That you can make the right decision ex ante and still be wrong ex post. And you are always in this industry measured on your ex post results. So if you're a PM saying, look, I'm diversifying my diversifiers to make sure that we are not subject to catastrophic loss in any market environment, but that costs us in almost all market environments, they can be fired during a benign market period where they're just overly implicitly hedged. And I think that's worth always acknowledging, because there's a very real component in this industry that is making sure portfolios are sustainable for people who are trying to manage their career risk as well. But I do think from your perspective, having that conversation, it is around identifying those environments where the way they are electing to manage risk will not work.
Yeah, no, absolutely. Is it okay if I continue more? It's a little bit longer with a few more topics.
Go for it. It's interesting.
Okay, cool. I wanted to just acknowledge a couple of our Twitter friends. I know, Corey, that people I'm sure you know as well, but Mike and Darren were tweeting this morning about, why alpha doesn't live in the comfort zone and so on and so forth. But since you've already talked a little bit about the no pain, no premium type thing, unless you want to add anything to that, which they were asking about, or saying at least they'd love to hear your opinion. I wanted to shift gear a little bit. And I want to talk to you about something that, again, I know it's something you have been diving into, but it's also something that we come across quite often. And that's the conversation between kind of simplicity versus complexity, and also, when is something robust and when is it kind of fragile. We often say to people who come, certainly people who ask us questions about, optimal settings, et cetera, and we often kind of give the feedback and say you also sometimes have to accept that, good enough is good enough. Because if you start making things too complicated, it actually doesn't bode well in terms of stability, robustness, and so on and so forth. So I'd love for you to dive into all of your sort of thoughts and findings in this area as well, if you don't mind.
Absolutely. And I do think we touched a bit on the idea that alpha can't live where it's easy.
Sure.
So I'll only say one sentence about that, which is ultimately the market both simultaneously loves and loathes an arbitrage opportunity. So when things are easy, the market is going to jump on it. So it ultimately means alpha has to be difficult to pursue, difficult to either get the information, analyze the information. It's got to be something that's structurally difficult for people to access, or it just has to be hard to stick with. And so unless it's hard, it probably isn't alpha, because a lot of people would just arbitrage it away. To your point on simplicity versus complexity, this is a topic that is near and dear to my heart for sure. I think there's sort of two things that happen. First, I will say there's this idea, and I mentioned this a couple of years back, actually, on a podcast with a good friend, Meb Faber, and I used the line that hubris sells, but humility survives. And what I meant by that was, in this industry, it is very often people are attracted to the complex. They want this very sexy, esoteric process. They want to be dazzled by quants wielding formulas. And the reality is, I think we all know, the more complex something is, the more prone it can be to potential overfitting. So you have that risk. On the other hand, there's this camp that believes that simple is more robust. And I do believe that is true, but only up to a point. And I think I'm stealing this from Mobison again, who sort of said, look, the benefit of simplicity versus complexity is almost an inverted U curve. That on the far left, when you're too simple, it's actually a drag. And then you get on the far right, when you're too complex, it's a drag. You need to find a happy medium. And so the very, very simple example I give, I wrote a commentary on this. I write a weekly research commentary. They're hit and miss. I like all of them. We'll let the audience decide if they like them. But another one I wrote was this commentary called When Simplicity Met Fragility. And to me, what's really interesting is you find that the very complex strategies are overfit and therefore fragile. But sometimes the very simple strategies are fragile because they're not diversified enough. So a very simple example, which will sound very naive to you guys, but these strategies exist in the wild, would be, I'm just going to look at the S&P 500, and I'm just going to look at its 200-day moving average, and I'm going to buy the S&P when it's above and sell the S&P when it's below. And people will look at that and run 100 years of back tests and say, look, this worked over the long run. How wonderful is it? And they just sort of look at the long-term annualized returns. The problem with that approach is you can find all these time periods where the market was 10 basis points away from changing its signal. That it was one afternoon or one day away, that if it had just had a slightly different return, the profile of that strategy would have been very different. And so in this study, in this weekly commentary, what I did is I took 3 ideas like that. So I think I did a price minus moving average crossover, another type of trend following model. And I said, all I'm going to do is I'm going to take the long-term return of the S&P, but I'm going to add a little bit of randomness to the returns every single day. And in just dosing just a little bit of randomness, I'm going to find out how sensitive these signals really were over the long run. And what I found in that study was that when you are just using a single signal on a single market, you are very, very, very subject to this idea of specification luck. You chose one signal, one market. And ultimately, whether you happen to just miss or make that 10 basis point day can have a huge compounding effect on your returns. And so in the study, what I showed was, all right, the very simple answer to this is don't just choose one. Why wouldn't we use all 3 models? And instead of having a binary in or out, now you've got something that's a little bit more like a dimmer switch. And when you added randomness to that portfolio, where the signals were being generated and you had more of a dimmer switch, the terminal wealth you achieved was far more consistent. And so what's interesting here is when we're measuring the risk, it's not really a risk in portfolio volatility as it's typically quantitatively measured. For me, it was the risk in what's your dispersion in terminal wealth that's achieved. And what you find is for highly, highly, highly simple models, that dispersion in terminal wealth is really wide. Now, just as sort of to put a bow on this, what I want to stress is this isn't, I'm not admonishing the idea that you shouldn't just use one signal. So I don't want to put words into Jerry's mouth, but when I was listening to him talk, he was talking about the idea of just using, hey, he's got this big portfolio, he's well diversified across holdings, he's using the same sort of signal on every single holding to avoid over specifying his signal. And going back to this idea of the 3 dimensions of diversification, your what, how, and when, to me, your goal should be to maximize sort of the volume of space that you're covering in those 3 dimensions to ultimately maximize how much diversification you have. But what you find is that if you have a lot of diversification in one axis, so let's say you're using a multi-asset futures portfolio and you're applying a single trend following signal, you have so much diversification, so many independent bets going on across all these different futures contracts that introducing another type of trend following signal doesn't have as big an impact as, say, if you were only using trend following on just US equities. So there's always a little bit of a trade-off here, but at the end of the day, It's really when you get to the point of having very little diversification and an overly simplistic model, you can create a very, very fragile outcome.
Fantastic.
Kind of like goes back to the point that I made earlier about those academic papers, right? Because I think some of them are guilty of exactly that, where they have not enough diversification in their processes and their signals, and therefore the result that they show, could be very sensitive to just a little bit of addition of noise, right? And if that noise existed or had existed in the past, the results would have been massively different. And it's so easy to overlook that fact. But proper research and testing of strategies, the way we do it or I do it, we actually, we have those things on our radar screen. We work with them. We test and stress test our systems to that noise, right? And we're trying to become as insensitive as we possibly can to those type of noise by exactly like you suggested. I like the picture of that with that dimmer switch, right? By not being so digital, by not being in or out, but having more of a smooth transitioning process as far as your positioning is concerned.
I think where people really struggle with this idea is very often the proactive act of including more diversification inherently hurts your backtest. So when people get started in this industry, what they tend to find is strategies that sound robust because they're simple, but we're actually the beneficiaries of positive luck. So I can point to a very real example. I'm not going to name the firm, but there's a very large ETF that applies trend following on US equities. And this fall, they were 40 basis points away from changing their signal. There's just basically one bad afternoon. But because that afternoon turned out a little differently, their signal stayed positive, and they ended up having a very, very good Q4. Now, the question we need to ask ourselves is, well, are we going to credit them with having a good process? Or do we think that that was just luck? Because they would have had a very bad Q4 based on how their process works. They would have gotten really whipsawed if that single afternoon had turned out differently. And I think when you're looking at a 50-year backtest, it can be really hard to sort of extract for people who really don't dig into the weeds quantitatively. It's hard for them to extract that impact of luck. But very often when I'm evaluating other people's strategies, you can see that they're saying this is simple and therefore robust. But what I see is this is simple and therefore was the beneficiary of tailwinds from luck. And we didn't recognize it was just luck, and that if things had been slightly different, this would not look nearly as good. And so what happens is when you start to incorporate these different models and diversification across multiple assets and diversification across when you rebalance, it typically hurts a backtest when you take a naive backtest and do that. But you see a dispersion in terminal wealth go way down. And so I think it makes it a much, much more reliable backtest than it otherwise would have been.
Yeah, I agree with that. Let's stick with the topic of risk for just 1 or 2 more minutes before we let you off the risk hook, so to say. But one of the things that I found in one of your documents and which I'd like you to explain a bit more about is, let me just quote that. It says, you prioritize downside, parentheses, drawdown, risk management above everything else. So I was wondering, well, how do you do this in practice, actually? Because it sounds a little bit like the Holy Grail there. In my personal experience, I mean, this is a byproduct of trend following. The personal experience is that, we have to accept the drawdown, have to accept the loss and live through it, because that's the byproduct of our robust trading system for the long run. But, so managing the drawdown and avoiding the drawdown and focusing on that is kind of like something that I'm not sure if that would work very well with trend following.
So I would actually argue and say that's exactly what trend following does. That isn't to say that trend following as a strategy doesn't have its own idiosyncratic drawdown that it creates. But when you apply trend following on top of an existing asset, right? So you're applying this mechanical strategy on top of US equities or on top of rates or currencies or commodities, you are ultimately trying to adjust the return distribution. And so what you tend to see is almost all of these assets have large negative skew, right? The expected positive return premium that you're going to earn from holding fixed income or holding equities comes from the fact that there's these large negative outliers that you're subjecting yourselves to. Again, just buy and hold really just means you're an insurance company, you're warehousing risk for someone, and you're going to earn a slight premium. Now, it's a very lumpy premium, but when those risks come around, you're going to feel the losses from the person who didn't want to hold that security. Not necessarily as true with currencies and commodities. I think there's a lot more nuance there, but at least we can talk about stocks and bonds in this way. Trend following, just mechanically, right? We all sort of know it's going to cut your losers short and let your winners run. And so what that does is it takes a positive convex profile and overlays it on this sort of negative skew and creates a much higher quality of return for investors, in my opinion. And what it ends up looking like is you end up almost giving up your best years to get rid of your worst years. Your left tails are cut off and simultaneously your right tails are cut off. And you actually end up with a return profile that when you run it through looks much more normal. Doesn't mean that you've eliminated volatility. It just looks a whole lot more normal. And in doing so, I at least have the belief that in reducing that risk, you help converge your long-term geometric returns towards that sort of long-term average arithmetic return. That those average returns, annual returns that you see over time are more achievable because you're not realizing this big negative volatility drag. And this is almost simultaneously benefiting those people who are more subject to that large drawdown risk in retirement. So I actually think trend following does exactly this concept.
Okay, just a little bit of technical issues there. So if you're listening to this, it might sound a little bit funny, but now we're going to jump into the next question I wanted to ask you about, Corey. And it's a little bit about time frame, but in a slightly different way. And I wonder whether you've given this some thought and maybe also how you deal with that, in particular when it comes to clients. So my question relates to the fact that if you live in a very nice place in California, so if the weather is, say, sunny today, and I ask you, what do you think the weather is going to be tomorrow, you probably say, well, it's going to be sunny. And but if I asked you, so what's going to happen in the markets tomorrow, you might say, I have no idea what's going to happen. It depends on who's tweeting or whatever. But then if we expand the time frame and ask you, what do you think the weather's going to be in 10 years? You probably say, I have no idea. But if I asked you about where the stock market's going to be, you might say, actually, it's going to be higher. Or if you think about trend following performance of a manager, for example, 10 years from now, well, the results should be, we should have accumulated more returns 10 years from now. So there's this funny negative correlation or whatever, however we phrase it, about certain things in life in terms of time frame, how we think about it. Something is easier in our world to predict long term, and some things that we find pretty normal in life is much easier to predict short term. Is this something that you think about in the way you communicate with investors? And of course, the goal being that we really want them to stay with these investments as hard as they are to stay with. We want them to stay with it for 10, 15, 20 years.
Yeah, I get what you're saying. Communication, I think, is a really important topic, probably one that doesn't get enough discussion in the investment industry, because to your point, alpha outperformance or even just whatever your performance objective is only really sustainable if the investor is sustainable. In other words, you can have a phenomenal investment strategy, but if investors are buying and selling in and out of that strategy, allocating, deallocating because they can't stick with the process or the returns are too volatile, ultimately the investor returns are not going to match the investment returns. And I think a lot of that comes down to communication. I think with quants, sometimes that can be rather difficult. There is, I think, a very human bias for narrative and story. We really like storytelling. It tends to be how we remember things. And quants very often don't have an outlook. We don't have a view. We follow our process. More often than not, we don't even know what's in our portfolios. Certainly, that tends to be very true for individual security factor folks who are just buying and selling baskets of stocks based on characteristics. And so we're not writing these long, flowery quarterly commentaries about the companies that we hold and the management teams we met and the wonderful glowing stories behind them. All we can really provide is attribution. But I do think there is opportunity for innovation there, where because we have a very, very systematic process, I do think there is opportunity for communication more graphically. I think quants, because everything is systematic and disciplined, have the ability to decompose their portfolio, not into the very traditional attribution analysis of sort of asset allocation versus security contribution, but really break down, these are the steps that we take. This is the recipe, and here's how each part of the recipe contributed to the returns. And I think in doing so, despite the fact most people think quant is very black box, we can make it more transparent. And I think in making it more transparent and providing graphical representation as to where returns ultimately emerge from, I do think that can take the place of this more narrative storytelling. But I do think it's very much an unsolved issue. I, for a long time, have not written quarterly commentaries. I think quarterly commentaries put too much focus on short-term performance, which I think any PM would tell you is mostly random anyway. It's only in outlier scenarios that you really have something meaningful to say. When I read other PM commentaries, it's sort of the same record on repeat every single quarter for a decade. And so I think it is important to repeat the same message, but ultimately at the same time, I think it can actually do a disservice to talk too much about short-term results. So I know myself personally, I have pivoted more to a methodology of trying to write less and graphically depict more, and hopefully through the depiction of what's going on in the strategy, more effectively communicate and get people to understand the process and buy into the process for the long term. And in doing so, hopefully make those results more sustainable for them.
I mean, I think just before, I know, Moritz, you have a question before we wrap up today, but it kind of ties in perfectly with this thing about the fact that we all have to write on our documentation or past performance is not indicative of future returns, but everything we do or everything investors do when they look for managers and have to select them is probably just the opposite to some extent. So it's pretty interesting. Do you think past performance, by the way, is a guide?
You know, it's a little funny because we all have the same disclosure. Past performance isn't indicative of future returns, but every single factor is based on the idea. Every single systematic investment strategy is based on the idea. I'm looking at this back test, and I do think this, sort of anomaly that I'm looking at will persist based on past returns. You are ultimately, at the end of the day, when talking to clients, very often talking about your past results, and clients are inherently trying to determine whether they think that relative performance or absolute performance will persist based on your process. I think the important distinction here is performance alone is not sufficient. I often, I don't think I'm alone on this, but I actually prefer back tests and live periods that contain a bit of ugliness to them. Because I think if you build a back test or a systematic investment strategy that only ever looks good, you're missing information. You're missing information about the risks in the strategy when things go wrong. And so to me, when I see live performance, I get just as concerned by live performance that's a positive outlier as a negative outlier. If I see someone who is a value manager that had an outstanding year when every other value manager had a really bad year, that concerns me because that implies style drift. So you do want this relative outperformance and this opportunity for alpha, but you also want to understand the process that someone's ultimately going through. So to me, there's always the tie between performance and process. But the more I can take the focus off of performance and retie it back to process, that's always where I want to anchor myself.
Yeah, absolutely. Moritz, why don't you take it away for the last couple of questions before we wrap up today?
Yeah, the last two. And, we always ask our listeners and friends if they want to submit questions for the show. And, here's a big thank you, because we've mentioned that you're going to be on, Corey, and we've received so many questions that, we'll probably be speaking for another 4 hours if we wanted to ask them all. So I'll pick two, which I liked, and the credit goes to Christian from Scalable Capital, a robo-advisor based in Germany. So here goes the question. Many systematic trading strategies, for instance, trend following, do rely on historic data of the underlying asset only, omitting potential external information from other assets. Do you think there is value in adding more sources of information, for instance, the momentum of related assets, financial stability indicators, or macroeconomic data?
Really like this question because I think you can sort of take it two ways. I think ultimately you have to tie all of these indicators, data, back to your belief around what you're trying to capture. So the question is, do you get a higher fidelity signal by including other information? So if we're doing trend following, is there a potential benefit to avoiding false trends and incorporating some sort of economic or fundamental information? I think you're seeing right now a lot of trend followers are starting to incorporate more information about carry into their process to try to account for that source of return. And the question ultimately becomes, in doing so, how much do you dilute your original signal? Do you remain style pure to what you were trying to do? And where's the risk trade-off? Are there environments that through incorporating these other signals, you might actually hurt your ability to, for example, follow trends because this signal is going to be giving a contradictory indicator in an environment that historically would have been good for trend following. So I think there's obviously this trade-off of pluses and minuses. The plus might be you get more information. It can enhance your the efficacy of your signals in certain market environments, but it can also muddy them, and it can also degrade them in other environments. And so I think it comes back to this idea of risk isn't destroyed, it's only transformed. I think you can apply that here as well and say, depending on what you're trying to achieve and what your ultimate outcome is, it may apply, it may not. I think for someone who wants the pure benefits of mechanical trend following, incorporating other signals, while they might lead to more stable return profiles, may actually hurt trend following in the environments that you might want to be buying it for. So again, I think there are always these trade-offs that need to be considered. I should note that I tend to have a focus on, when I think about combining signals, it is in more of a portfolio context. So I am more pro the approach of, I'm going to build a portfolio based on one set of signals. I'm going to build another portfolio based on another set of signals and combine those signals together to create that dimmer switch. There's another field of thought that says, let me take the two signals, bring them together, and create only a single signal. And I think in doing that, you might enhance the information in that single signal, but you give up the potential diversification that comes from having multiple signals. And so I think that's another important trade-off you need to consider, which is, how are you baking these multiple signals into the portfolio at the end of the day? Right.
Interesting. All right. Here's the perfect question to wrap things up. And the credit goes to a good friend of mine, also named Moritz, by the way. And it's, the key question: how do you invest personally, Corey? Does it all go into the ETFs that you guys manage, or is there anything else you do?
This question gets me into a lot of trouble because I've got very specific views on this. So I need to start by saying that I am co-founder and 50% owner of the company that the asset management company that I run. I have a tremendous amount of assets within that business invested in our strategies. So whether they're seed accounts or things like that, we have a large amount of capital invested in our own strategies through there. I also have a large amount of assets invested in the strategies personally. So you can look up, through our prospectus and SAI, how much I actually have personally invested in the different funds. And I think it's important that the chef does eat their own cooking. But I also, again, going back to this core concept of risk, it's never sat well with me that a PM should be 100% invested in their own strategies, particularly if they are not meant to be strategies that would be 100% of someone's portfolio. When I look at my total personal balance sheet, when I look at my mix of human capital and personal capital, I am highly, highly levered to the market. Not just the market, I'm highly levered to my own investment strategies. My entire last decade has been spent trying to build a business that generates revenue, not only through market exposure, but through our approach to getting market exposure through the investment strategies we have. So if I were to then not only have all my human capital highly levered to that, but also have all my investment capital invested in those strategies, to me, that would be the sign of someone who really doesn't understand risk all that well. That if I'm thinking of personally diversifying myself, it doesn't make a tremendous amount of sense for me to be so highly levered personally from the type of revenue that the business generates and my illiquid capital, as well as having all my liquid capital tied up in it. So I do think it's important that I do eat my own cooking, but I use my own strategies very much in the same way I advocate for others, particularly others who are of my own age. So I'm in my early 30s. It may not be appropriate for me to have more conservative strategies as heavily weighted in my portfolio. So I do have, just to sort of round it out, what's the picture look like? I probably have about 50% of my portfolio in sort of long only, high quality equity names. I have a little bit of private equity investment that I've done, which is, you can sort of just think of as a levered equity investment. I have a suite of multi-asset strategies that I invest in. So that would be some of our own multi-asset strategies, as well as other sort of credit-based strategies that represents another sleeve. I have another sleeve that's more trend-following strategies. So a mix of multi-asset CTA type strategies, as well as our own trend equity strategies. And then finally, I have some fixed income that I just have in there as a buffer, because again, I think I'm so highly levered to the market on the illiquid human capital side of things that I actually like to carry around probably more traditional treasury fixed income safety assets than someone else my age probably should, but only because when I look at that total balance sheet, I've got so much exposure to the market pretty much everywhere else in my life.
Got it. Thank you. Very interesting.
Yeah, thanks for sharing that. Now, before we wrap up, let me just do as we normally do here, just go through and see where the indices for CTAs, left Thursday evening. So this is as of Thursday night. The BTOP 50 index is up 1.5% roughly, plus 4.73 for the year. The SocGen CTA index up 1.79% for the month of June so far, up 4.04 for the year. SocGen Trend Index plus 209 for the month, plus 6.75 for the year. And the Short-Term Traders Index up 108 and down still for the year, down 0.75%. And the Bridge Alternatives Index up 1.53 for the month and up 5.41 for the year. Now, as usual, please keep sending your questions to us at info@toptradersunplugged.com. Corey, thank you ever so much for spending your Saturday morning with us. We really appreciate it, and I'm sure our listeners do as well. And it's absolutely as inspirational to hear your voice as it is to read your tweets and your research papers. So that was a real treat for us. And maybe you can share with our audience what's the best place for them to keep track of you, so to speak, and learn more.
Well, first, let me start by saying thank you guys so much for having me on. It's a real pleasure. It's a great conversation. Really enjoyed. If people want to learn a little bit more, they can find me on Twitter under the handle C Hoffstein. I have a weekly research commentary I write that you can find. I link to it via Twitter, but also you can go to our blog.thinknewfound.com. I also have my own podcast. Season 2 is coming out in hopefully about a month. And the podcast name is Flirting with Models.
Great name. I like that. And also for all of our listeners out there, if you wouldn't mind, please share this with a friend. And if you would really make us happy, take 2 minutes out, leave us a 5-star rating and review if you think we deserve it, of course, as it makes a huge difference in where we show up in the podcast rankings. So we really would appreciate this. From Corey, Moritz, and me, thanks ever so much for listening. And we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.